Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Business Finance and the course code for this subject is BS 151. This is lecture number 21st and the topic for today's discussion is risk attitudes of investors. The outline of this lecture comprises of what is a risk while investing. Like we'll discuss that what type of risk an investor is going to have while he is going to take an investing decision. Secondly, it will cover the discussion related with systematic versus unsystematic risk, which are the two broader types of risk factor involved in any economy. Third, the investor's attitudes towards risk. What are different types of attitudes of the investor while he is taking investing decisions? So dear students, after listening to this lecture, I assume that you should be able to understand or have grip on the following 3 points. Number first, you will be able to understand the difference between systematic versus unsystematic risk. Like what type of risk is known as systematic and what type of risk is known as unsystematic risk involved while you are investing in any security or a portfolio of stocks. Secondly, you should be able to understand the certainty equivalent concept in detail. And third, you should be able to understand the 3 different types of risk attitudes of the investor. Let us discuss what is a risk. As we have previously explained that risk is actually the variability or the deviation in the return realized and the expected return of the investor. Like at the start of the investment, the investor was of the opinion to have an expected return of 10% from a stock, and at the end of the maturity, if the investor has realized certain return which is less than the expected returns, so therefore we can explain that there was a particular risk factor involved in the investment of that share which causes decrease in the expected return or the original return realized. How can we define what is a total risk while an investor is going to take an investing decision? So normally he is encountered with 2 types of risk. One is known as systematic risk and the other one is known as unsystematic risk. So systematic risk is a kind of risk which is out of the control or unable to control this risk by the investor with the help of different investing strategies. So we can say that we can infer that this is a risk which is related with the overall economy of the country or the world and which is normally uncontrollable by the investor. However, the unsystematic risk, as the name narrates and explains that this is not related with the overall system or the overall economy of the country. Therefore, unsystematic risk is controllable with different portfolio and investment strategy by the investor or any other investing agency. So these 2 types of risk are explained just beneath the yellow factors in front of you. This diagram actually explains and bifurcates the difference between the systematic and unsystematic risk. On the horizontal axis, we have number of securities in the portfolio. Now, what is the meaning of portfolio? Portfolio is actually the accumulation or the total inclusion of the number of shares or the securities you are going to put your money in. Like for example, if you are going to invest in the 5 different stocks of 5 different companies, then this overall accumulation of 5 stock will comprises of a portfolio. Secondly, if you have decided to go for certain debt instruments and certain equity instruments, like you are going to invest your money by 40 and 60% in order to diversify the risk. So therefore, there will be debt and equity portfolio in your investment. However, if you are going to invest in a single share or in a single stock of any company, that is not a portfolio, rather it is a single security investment. So the basic purpose of making portfolio is to diversify the risk or to minimize the overall total risk of the investor. On the vertical axis, there is a risk measure which is known as the standard deviation of portfolio return. This vertical axis shows the standard deviation, which is a measure of risk, and similarly the horizontal axis shows the number of portfolio in your number of securities in your portfolio. This red highlighted section shows the total systematic risk involved if you are going to increase number of securities in your portfolio. So we can see that if the number of securities in your portfolio is only 1, then you are going to encounter or have the same amount of systematic risk as, for example, if you have 8 number of stocks or securities in your portfolio. So the systematic risk will remain intact and same. Why? There are certain factors such as changes in the nation economy, like the government has changed the economic strategies, that those are out of the control of the investor, and similarly out of the control from those companies which are operating in that particular economy. Or the government is going to take a tax reform, like previously capital gain was not taxed, but today or in the couple of years before, when the government has taken decision to impose tax on the capital gain as well, that was known as a tax reform by the government. So such kind of action is out of the control of the portfolio manager or the investor, and therefore is known as systematic risk factor. Similarly, third factor is change in the world situation, like a situation, contingency situation, a war situation, or any epidemic and a pandemic situation. Currently, we are facing nowadays that this COVID pandemic has excessively affected the world economy, and many businesses have been suffered adversely because of the such worldwide changes or world situations. So these are the factors which are out of the control from the the portfolio manager, and as well as an individual investor, if he is expert enough to design a portfolio of investment so that his risk factor may be minimized. So we can see that irrespective of the fact the investor is going to invest in 1 security or 8 number of securities, the systematic risk cannot be minimized and it will remain as it is. However, the unsystematic risk, such as highlighted in blue, can be controlled by portfolio manager or an individual investor. Like we can see that if the portfolio manager has opted only 1 security to invest money in, then the systematic risk is up to this point, plus, as the formula says, the total risk is equal to systematic plus unsystematic risk. So therefore we can see that the unsystematic risk involved in this investment, if the investor is going to opt for only 1 security to invest money in, then the overall risk will be right from bottom or 0 point to the point of intersection. So dear student, you can see that with the passage of time or with the increase in the number of securities in the portfolio, like starting or increasing number from 1 to 4, let's suppose, Then the overall systematic risk is once again same. This is the point of intersection. However, we can see that the unsystematic risk has been reduced from, let's say, point number 10 to point number 7. So we can see that the overall risk, if the investor or portfolio manager is going to invest money in 4 number of securities and going to make a portfolio, then the overall risk or the total risk of this investor has been minimized from 10 to 7, because with the increase in the number of securities in our portfolio, the unsystematic risk has been diversified and the overall risk factor will reduce. What are those factors which are pertinent to the unsystematic risk? So these are certain factors. For example, factors unique to a particular company or industry are known as unsystematic risk, and these factors will only influence that specific company or industry. For example, the death of a key executive in a particular company will adversely affect the stock price of that specific company. However, rest of the companies listed on the stock exchange will not be affected by the death of any key executive related or pertinent to a specific company. The other factor can be loss of the government defense contract. So that such kind of factors may adversely affect that specific company related with defense. Therefore, we can finally conclude that with the increase in the number of securities from 1 to 4 and then from 4 to 10, let's suppose, we can see that the unsystematic risk has been minimized, which is fewer risk over here. However, the systematic risk right from the bottom to the top, this section, let's suppose the systematic risk involved in the economy is 5%, then the systematic risk has not been minimized with the increase in number of securities in our portfolio. However, the unsystematic risk has been reduced from point number 10 to point number 6, maybe, like if we have increased the number of securities up to here. Now let us discuss what are the different risk attitudes of the investor. In order to understand the risk attitudes, because there are different investors having different type of attitudes. Some of the investors are risk taker, which are known as risk preference investors. Some of the investors are risk averse and they would like to opt for the safe zones and safe havens for the investments. What is a certainty equivalent? Certainty equivalent is the amount of cash someone would require with certainty. Like, for example, if an investor has invested certain amount of money in a particular investment opportunity, therefore, in order to forget about this investment return, the investor may ask for a certain amount, which is known as certainty equivalent, so that at a point in time, to make the individual indifferent between, like, either to get the return at the end of the maturity from your investment or from certainty equivalent amount. So therefore, we can say once again that certainty equivalent is a certain amount which someone would require with certainty without taking any risk at a point in time to make the individual indifferent between the certain amount or to go with your own investment. This is known as indifferent between the two options. When both option looks very nice and good for the investor, then investor is known as on the indifferent position between certain amount and an amount expected to be received with risk, because this investment is actually having certain amount of risk factor as well. So therefore, when the investor is indifferent between either to go with his own investment or portfolio of investment with certain amount of risk factor involved, or with the particular certainty equivalent which somebody is going to offer that investor, that leave this investment of portfolio portfolio of investment and go with this certain amount. And when the investor is indifferent between the option to opt for his own portfolio of investment or to go with the certain amount, that is known as certainty equivalent. This phenomena will more be elaborated shortly in the next few slides. So we have normally three different kinds of risk attitude. If the investor is at the risk preference attitude, then this certainty equivalent amount which is demanded by him should be greater than the expected value realized from portfolio of investment. Risk indifference attitude of the investor says, when the certainty equivalent amount, let's suppose the certainty equivalent by an investor is 100 and the expected value from the expected value from the portfolio of his investment is also 100, then the investor's risk attitude will be the risk indifference, either to get the certainty equivalent, which is $100, or to go with the expected value of his own portfolio, which will once again give him $100. So therefore the investor is on the risk indifference position, because both the options are realizing the same amount of return at the end of the day. The third risk attitude is risk aversion. Most of the individual or investors are risk averse and they would not like to go with the risky investment. So when the certainty equivalent of an investor is less than the expected value, let's suppose the expected value was $100 from a particular portfolio of investment and his certainty equivalent amount is, let's say, $80, then we can say that the investor's risk attitude is risk aversion, because this investor is not going with his certain portfolio of investment, because this portfolio is actually having certain amount of risk factor which will ultimately reduce the expected return at the end of the maturity. So therefore the investor is looking to have the certain amount of dollars without any risk, which is 80. And when the investor go with such kind of condition, then investor's risk attitude is known as risk aversion. Like he is avoiding to take the risk. Rather, he is more inclined towards the certain or sure amount of $80. This will be further elaborated with the help of a numerical case. Risk attitude example. For example, you have the choice between number first, a guaranteed dollar reward, which is known as certainty equivalent, as we have discussed, or secondly, you are going to have a chance to have a coin flip gamble of $100,000, where 50% chance is to win this $100,000 and 50% chance is there that you will realize $0 or zero return. If a particular investor is in such kind of situation where either he will realize $100,000 or will realize nothing at all, and it all depend upon the coin flip or flip of a coin, which is a gambling position or a gambling game. Therefore the expected value of the gamble is $50,000. 50% chance is to earn $100,000 and 50% chance is to earn zero. So therefore the overall expected value of this gamble is $50,000. There are three different investors, or rather I can say there are three different individuals who are involved in such kind of situation. In order to explain the risk aversion, risk preference and risk indifferent individuals, let us take the first example, which is the Mary requires a guaranteed $25,000 or more to call off the gamble. Mary is a kind of person who is looking to have a guaranteed $25,000. Like if somebody is going to give or offer him $25,000 to give up or leave this gambling game or gambling position, which involve flip of a coin, because he want to reduce the risk of realizing $0 if the desired outcome from the flip of the coin doesn't favor Mary. Like if the Mary asks for head and the flip of a coin turn out to be in tail, then ultimately the Mary will realize nothing at all. So in order to reduce this risk factor, he was demanding a guaranteed $25,000. As the expected value or the certainty equivalent of this gamble is 50,000 as given in the data, and the Mary's guaranteed value is less than the certainty equivalent, which is 25,000 or more to call off the gamble. Therefore, we can say that Mary is on the risk aversion position. There is another individual which is named as Riley, is just as happy to take 50,000 or to get the risky gamble. So the Mary's the Riley's guaranteed amount or expectation amount is $50,000, similar to the certainty equivalent. If somebody is going to give 50,000 or more amount, then Riley will give up from this gambling position. And there is a third person named as Shannon. Shannon requires at least 52,000 to call off the game. So here we can say that the Shannon's certainty expected value is 52,000, which is quite greater than the certainty equivalent or expected value of the gambling game. So how can we say that which individual or which person is at what type of risk attitude? So what are the risk attitude or tendency of each individual? The Mary shows risk aversion. The reason is because her certainty amount or certainty equivalent, which was $25,000, it was less than the expected value of the gamble, which was $50,000. So when the Mary's certainty equivalent is less than the expected value of the gamble, we can say that she is avoiding to take the risk and she is on risk aversion's attitude. The Rally exhibits the risk indifference. The reason was the Rally's certainty equivalent was 50,000 and the expected value realized from this gambling was 50,000 as well. So both amounts were same, and the certainty equivalent was exactly equal to the expected value of the gamble. Therefore, the Rally's risk attitude was risk indifference. Like whatever position Rally is going to opt, the same amount will be realized at the end of the gamble, or at the end of the game, or at the end of the decision. Now let's come towards the Shannon. Shannon reveals that risk preference attitude. Why? Because her certainty equivalent was 52,000. She was demanding $52,000 to give up the expected value, which was 50,000 in this case as well. So when the certainty equivalent of any individual or investor is greater than the expected value of the gamble, therefore we can conclude that the person or investor is on the risk preference attitude. So we have finally explained and clarified that there are three different risk attitude positions, which all depends upon the certainty equivalent of the individual investor. So this was all about the three different kinds of risk attitude of the investor, and as well as what is a systematic and unsystematic risk. But still, if you have any question or confusion, you are free to ask question by posting them on KCMS, or you can also email me on my registered email address as mentioned in the footer. Thank you very much for listening to this lecture. Good luck for the day. Allah Hafiz.